Hi, my name is Tony Suick. I'm a financial advisor and one of the partners here at Lifetime Retirement Partners. And I'm here today to present our quarterly outlook for the first quarter of 2026. We go through and I'll discuss in great length our expectations for the stock market, kind of where we've been so far this year, and our outlook on the shape of the economy, the strength of the economy. I will warn you on the outset that the quarterly report isn't really for the faint of heart. Probably about a 45-minute video to really walk through everything in great detail. If you're not looking for that kind of commitment in your life right now, in a couple days we'll be posting a similar monthly version that's about 10 minutes long, usually 10 to 15 minutes, and covers all the similar points just on a more of a surface level. Now, I will tell you, if you stick with me for the duration of this video, I guarantee at the end of it, you'll know a lot more about the stock market and the economy than you did on the first, before this video ever existed. So I do hope you'll give it a chance. So we're going to go through and, again, about 45 minutes, cover everything that's happened in the stock market and the economy so far for 2026, kind of where we're at right now. And I'll go through in pretty good detail how do we think the economy looks. So kind of, I know I'm repeating myself a little bit, but we'll jump right into it here. So looking just at the first quarter of 2026, it has been a little bit of a tale of two halves of a quarter, meaning that the stock market looked, and we'll start with the stock market for the first probably half of this video. We had a stock market that looked different the first 2 months than it certainly did the third month. It's been a very interesting time to be an investor. We started with what looked like a pretty normal sector rotation, and I'll explain that concept in a second. And then all of a sudden, the conflict in Iran started, and everything was completely different than it was the day before. And so I'm going to walk you through. And by the way, the material that I'm covering here, our quarterly economic outlook, is also available on our blog on lifetimeretirementpartners.com. You can find links on our social sites as well. And so let's talk about the concept of a sector rotation, which I know is sounds like an Econ 301 kind of scary terminology. But sector rotation is actually a fairly straightforward concept, and once you understand it, you'll understand a lot better what's been happening in the economy so far. So a sector rotation, and you can see it here on our first slide, happens when growth loses its leadership, when people move their money from one pot to the other. And this is a study that we put together to kind of define it since 2010. Growth, and then you see there down in blue, and you see the three cohorts: small cap, value, and foreign. And I'm mostly going to use value as my proxy for non-growth. So a growth stock would be like a Tesla. A value stock would be like a Procter and Gamble. And you can see most of the time in this study, 54% of the time, growth was ahead of foreign, value, and small cap. And I don't mean ahead cumulatively, but in X year, it did better than the other three did individually. And so we call that growth leadership. Growth can lose its leadership. Now, maybe I'll start at the very beginning if it isn't self-evident. Growth is the leader because it's growth stocks. It's not always necessarily the same growth stocks. They change over time. But growth dominates because if it didn't, it wouldn't be growth. I don't know a more transparent way to say it than that. But growth can lose its leadership for different reasons and for different periods of time. You can see usually not sustained or very long periods of time. The primary reason why growth wouldn't be a leader in the stock market is because we're in an economic downturn. That's actually what you see in 2022. You can see on the graph there, green, yellow, purple, leading growth for most of the year. Well, it's not because all of a sudden value stocks were doing amazing and blowing growth out of the water. It's because we were in a very bad economy and a very bad stock market during most of 2022. So to say value was leading growth is really to say that value declined less than growth. Growth is going to struggle during rougher economic times. It's going to fall first, if you will. People will move in, and this is kind of the rotation you want to imagine. People will move in from growth to value when they think the economy is weak, because they'll sit there and collect a 2% dividend in Procter and Gamble, eventually realize this company is not growing very fast. Maybe it's growing 2 or 3 or 4% a year. And so there's inevitably a time to rotate back into growth. That's the sector rotation. You can also get the same basic thing if growth is simply has run too far too fast, meaning the multiples are starting to get stretched. By comparison, other categories like foreign or small caps start to look attractive, but in the long term aren't going to have the same components that growth do for long-term investors. And I take the time to walk through all this because so far in 2026, that's really that latter kind of rotation is exactly what it looked like. To give you a little more background, in 2025, we had an awesome summer, we had an awesome fall in the stock market, but then in October, we suddenly started seeing a lot more volatility in the stock market. The market went through a sideways period where it was kind of struggling after setting all-time highs all summer and all fall. It was kind of struggling to get back to those highs. And so we would almost scrape against them, almost scrape against them. And then in December of last year, growth started to lose its leadership compared to value stocks. And actually, small cap was what took over first, but then foreign, value, small cap, you can see at the very end of the graph, all outperforming over the last couple months. And so but part of the point, that doesn't necessarily look like a breakdown of anything. Growth stocks didn't suddenly start underperforming. They didn't suddenly start making less money. If anything, they've still been doing really good in terms of earnings so far in 2026. And so by just about everything you could look at, it looked like a pretty standard sector rotation where we were taking money out of growth and rotating it into these other categories. And for the first 2 months of the year, that was the right thing to do. And then Iran happened, and this is extracted from our quarterly report. So this sheet here, I just copy and pasted it from the quarterly report that we published on Friday, April 3rd. And on the table here, you can see bifurcation starting in the first column, January 1st through 2/28/2026, which is that weekend is when we started dropping bombs on Iran, and all of a sudden we're in a global conflict. Now, before that happened, you can see that the sector rotation was working exactly how it was supposed to. The second line item there, emerging markets up 12.5% for the first 2 months of the year. Right below it, international equity, developed markets up about 10%. Growth towards the middle, Schwab US large cap growth is the proxy I use there, down about 6.5%. The Russell 2000 index, which is my small cap, up 5.4%. And then mega cap value up 7%. So everything mechanically is working exactly how an investment manager would expect it. But then all of a sudden we're in a global conflict, and you can see that the column behind that, starting March 1st, all of a sudden the things that were supposed to be working weren't working anymore. And that's not because it was the wrong investments, it's because everything was down, right? Starting March 1st, gold is down, bonds are down, growth stocks are still down. And in addition, small cap is down, value is down, emerging markets, foreign investments are down. And those are the biggest losers, because who wants to own foreign investments when there's a regional conflict or a global conflict, if you want to say. And so that's really, again, the tale of two two halves of one quarter is kind of how you define that. This goes through March 30th, and of course, there was a rebound on the very last day of the year. But I wanted to make sure I could clearly illustrate what that meant in kind of terms of the market and returns that people would probably see inside of some of these different categories. So, this decline, what does that mean for us in terms of being an investor? And the way to look at that is if we think the decline is structural, meaning there's something that's broken down in the economy, or if it's transitory, if it's something that we can expect a pretty good rebound once the conflict in Iran is done. And that's really my base case, and I'll show you why. So at Lifetime Retirement Partners, we maintain an index that I call the LMVI, Lifetime Momentum and Volatility Index, and you'll be able to see that right here. Um, the it's built around four components. Two of them are market components, two of them are economic components. And what it's meant to do is separate good volatility from bad volatility, or at least in the market, unimportant volatility. Um, it's designed on a scale of -4 to +4. And you can see here the last 52 weeks in the blue there. Most of the time, this is going to return a positive signal. And that's probably pretty intuitive because most of the time, I mean, if you aggregate things over 20 years, the most common day in the stock market is that things go up just a little. The default should be growth, right? But there are times where we get these periods of spikes in volatility in the economy that happened under Liberation Day, that happened in October. Like I said, there was a big volatility surge there, and that happened in the last really 2 to 3 months. We've been seeing a deterioration in the volatility of the stock market, meaning an increase in volatility. This index, again, -4 to +4, had been running a 3 for a pretty strong period of time to start the year. And then all of a sudden, AI and Iran, and I'll come back and talk about AI in conjunction as well, um, started pushing the score down. And so right now we're in kind of a risk off position. Not that we're necessarily looking to day trade people's portfolios or anything like that, but I do think that there's some times where it's okay to try to A, create a little bit of dry powder, just a couple percent in an account, and B, try to lower volatility in the accounts a little bit. And so again, we're in a little bit more of a risk off position. But what's important to understand about this is that the way that it's structured, again, there's two market components and two economic components. The market components, meaning the VIX, the volatility, and the S&P 200-day moving average is the other one. Those two components are the ones that are causing the negative score, but the economic components haven't revealed any weakness. And so I'm going to justify that in a second with an even clearer indicator. Um, but that's where I say we see weakness in the stock market, but we don't necessarily see weakness in the economy if everything's over with Iran tomorrow. And I'm not going to offer a commentary on, my crystal ball is not going to go into that depth. But or so far, it sure seems like there hasn't been any resulting weakness in the economy from the conflict. You don't have to go very far to find advice that the longer the conflict goes, the more problematic it is for the stock market, and for the economy, and then the stock market, I should say. So then I want to combine that with what we call our early warning system. The lifetime early warning system is something that we built to measure fragility in the economy. And so it's somewhat similar in concept to the momentum and volatility index that I was looking at before, but it serves a different purpose. And it takes 8 different components and ends up, we'll go here, ends up creating a score of fragility using components that are said to be leading economic indicators. And so this is updated weekly. We review it constantly, and I review it in combination with the volatility and momentum that we see in the stock market or don't see in the stock market. Um, to say, okay, is there really fragility here? Or is it just a little bit of short term variable volatility? And that's certainly what the reading we're getting so far, where just to give you a couple quick examples, and again, this is all available on our website inside of the economic presentation for the first quarter. But to give you a couple quick examples, we use high yield credit spreads, commercial bank deposits, yield curve, a measurement of bank stock rotation versus the S&P 500. I won't sit here and read the whole thing to you, but things that I believe are leading economic indicators that for different reasons are going to show fragility in the economy before hopefully it shows up in the stock market. The point, and I'm going to keep this very short for today and move on to some other items, is that we see a score of fragility right now of 2.3 on a scale of 0 to 10. It's one of the, there are a couple blips in history where back tested this would have scored a 0 or near a 0, but this is awfully low fragility. Not to say that if we have a conflict that we're involved in for 6 more months, not to say that this thing wouldn't start becoming affected because the economy is starting to become affected. Obviously, that's probably true. That's probably what would happen. But it hasn't bled through into any of the underlying data yet. And that supports my understanding of the market in the short term, at least right now, that we've seen a lot of difficulty in the stock market, but we have not seen a lot of fragility in the economy to go along with it. If the conflict was over tomorrow, we'd be in a very strong economic position, actually, and a very strong position for the economy to start rebounding. The stock market, that is, to start rebounding. So that said, I want to semi-pivot and start going through some things, just our outlook for where we think we are in the economy right now. And then we'll tie some of these pieces together at the end. And so to go through first, I want to talk about kind of the valuations we see in the stock market, because that's really the last kind of market related piece of the presentation. And some of it's a little misleading, so I'm going to give it to you with some caveats. When I'm really looking here at the bottom, first to just explain it in case anybody watching isn't familiar, the short explanation. When you, and I'm just going to make up numbers, but when you compare stocks, right, and Apple's $200 a share and Amazon's $400 a share, well, those numbers, one compared to the other, don't mean anything, right? Because one might have way more shares issued than the other. And so the only way to compare stock to stock, Apple to Apple, is to divide what the company earns by its stock price to create a comparable ratio. That's a price to earnings ratio. That's what we use in the market all day long to kind of figure out how are things valued when the actual stock price doesn't tell you all that much. I always use the S&P 500 as my main proxy, even though I have a couple indices listed here. And so towards the bottom of that table, S&P 500 index, current price to earnings ratio, and trailing price to earnings ratio. You can see the current is 23.73, and that means that we take the earnings of the last 12 months and divide it into the stock price, and we end up with the ratio. Now, we do that for the index, is that we do that for every stock in this, all 500 stocks, take all of their earnings, divide it by all of their stock values to create a comparable market indicator. So the level of the S&P 500 right now is 23.78. 12 months ago, the exact same number was 23.15. So are stocks technically a little more expensive than they were a year ago? Yeah, actually they are, even though we've been in kind of a free fall. How can that be? It's not necessarily because stocks were overvalued. We were in a free fall at this point last year too, right? The market was soft even leading up to Liberation Day, which was actually, I keep referencing that, but that was actually kind of the valley before stocks started taking off again. And so we saw a lot of market weakness during the exact same time period. So it is a little bit of an apples to apples comparison. It's also a little bit of strange because you're comparing two time periods where the market's been dropping, and saying what do the multiples look like. We haven't gone down percentage-wise quite as far as we did last year at this point anyway. And so it looks slightly strong. Um, what's important, you don't buy a stock based on what it's earned last year necessarily. You buy a stock based on what you think it's going to do 1 year in the future, or 2 years in the future, or in some cases, studies even look at 3 to 5 years in the future. Although the longer those time horizons get, I think that starts to resemble more and more guesswork, right? So we're usually looking 1, maybe 2 years out in the future on projections for earnings and saying, okay, divide the current stock price by the future projected earnings, and we get a number of 20.44 in the S&P 500 for the future 12 months earnings. 20.44 is also slightly more, and you don't see that on here, but trust me, it's slightly more than it was 1 year ago. But if you exclude the weakness around Liberation Day in 2025, it is actually, stocks on a forward basis are the cheapest they've been since 2023, thanks to this pullback. And that's true because we've had pretty good earnings so far in 2026. Not gangbusters, but good. But we've seen a stock market decline. And so as earnings go up and prices go down, you start to see better and better comparables to other time periods that aren't 2025 when the stock market was just dropping. So let me explain that in a little more detail. Earnings season. And so this is what stocks tend to correlate against more than anything else. In the short term, you see stocks trading up and down. You're either going to have moments like a conflict in Iran, which the stock market is very sensitive to. But excluding an event like that, when you see stocks move monthly or quarterly, it's usually going to trade mostly around what they announce in terms of earnings season. So earnings season, every quarter, stocks have an announcement and they say, we earned X amount in revenue this quarter. We earned Y amount in net revenue, basically earnings per share for the quarter. And in most, not everybody does, but in most cases, they'll say, and here's our outlook for the next year, or at least for the next quarter, kind of updated from what we announced the quarter before. And so once we get this material information, stocks tend to reprice pretty quick based on the announcements. And I won't say especially, but also based on the expectations for future earnings. You can see here, a lot of us, including myself, thought there was a potential recession at the beginning of 2025. And part of the reason for that is because we had a very weak earnings season, the weakest one in a couple years, where only 59% of companies beat projections. Let me take a quick beat and explain that. I know I'm starting to get pretty in depth on some of these things, and I don't want to go too far afield. When it's kind of a weird dynamic. There's a whole cottage industry of trying to predict what these companies are going to announce before they actually announce it. During a good, booming economy, one of the hallmarks is stocks overperforming those expectations. Analysts don't keep up with the growth. And one of the signs we're at the top of the economy, at the top of a bull market, is that analysts start to get more and more aggressive with their projections, but companies start to slow down and those numbers start to tighten. And that's what it kind of looked like a year ago, 2025 quarter one. 59% of companies overperformed their gross revenue expectations. But since then, we had two extremely strong quarters, 2025 quarter two, quarter three. 2025 quarter four, like I said, it was good. It wasn't as strong as the two previous quarters. It was certainly good. And so the last quarter of last year, quarter four, is what we would then turn around and announce starting in January. And so we've been going through announcements for the previous quarter. Most of the numbers have been good. 73% of companies overperformed on a gross revenue metric, and 74% of companies overperformed on an earnings per share metric. The average size of the outperformance was pretty good, especially on earnings per share, not as good on gross revenue in terms of the margin of overperformance. These are good numbers. If we turn in numbers like this quarter, 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 theoretically, there's no reason we would ever hit a recession. Of course, that's not necessarily how it works, but I'm just saying it's what we just went through in the first quarter of 2026 is getting a bunch of really good releases, getting a bunch of really good future projections, but the stock market dropping down. And again, that starts to create a delta where we've gotten a good earnings season that hasn't really been priced in the stock market yet. Or you could also argue that stocks were a little bit ahead of themselves, and that has kind of been reset now. We don't have it in the slide deck here, but I do have it in my quarterly report, the write-up. It's just as this long video isn't for the faint of heart. The quarterly report's about 25 pages, and there's some really good stuff in there. I cover some of it here, not all of it. I would encourage you to look that up too at lifetimeretirementpartners.com. But I had some information in there on expectations for 2026 you won't see in the slide deck here. So expectations for 2026, analysts are expecting earnings per share to grow about 14% this year. And you can imagine in a normal market where things aren't getting more expensive or cheaper, that if earnings in stocks go up 14% and maybe if future projections go up as well, then of course stock values go up. Otherwise, they're just getting cheaper and cheaper. So just to maintain equilibrium, to have a decent year in the stock market, as long as these numbers keep climbing, then stock values will keep climbing as well. That's really kind of the last piece on stock valuations. And so I want to turn and pivot to a bit of a discussion on a view of the economy. So in addition to the items we just went through, the volatility index, the early warning system, we maintain a proprietary database where we break the economy into different sections, so we can kind of look at the components individually and get an idea if we think it's a strong economy, a weak economy, or somewhere in between. And I break that down into a whole bunch of different components here, but it's in terms of three broad pieces of the economy: macroeconomic indicators, strength of consumer, and monetary indicators. And then I have a window there for market fundamentals, which we just went through as well. On each of these three economic components, meaning put market fundamentals aside for a second, we have a scale of -2 to +2 to ascribe their health. And you can see there macroeconomics, I think is very strong right now. Monetary policy, I think, is very strong right now. Strength of consumer is a 0. Last quarter it was a -1. So in part because of improving unemployment numbers, we've seen some strength develop there. I believe we're in the middle of a bull market right now in terms of just where are we in the economy. We all know we go through different phases in the economy where things are booming, and then all of a sudden there's an economic downturn, and eventually you get to the point where things are booming again. Right now, I believe we're in a mid-cycle economic expansion. And a couple quick data points. I won't sit here and read every slide to you, but a couple quick data points. Obviously, we have expanding gross domestic product, or as I'll talk about in a minute, gross output is another factor we like to look at. We have sufficient or expansionary bank lending. Some of these I'll talk about in much better detail, so I'm just trying to give you a quick overview of what happens in an expanding economy. Individuals, households are spending without taking on debt. Usually we would expect to see wages growing faster than inflation, labor markets that are stable, so et cetera, et cetera. And when you look at the inverse of some of these, you can start to get an idea. What do we look for in terms of hitting the peak or moving towards an economic downturn, right? So you could just say the opposite of just about everything I said: contracting growth in the economy, a declining labor market, inflation, which is pushing higher than wages, et cetera, et cetera. And so we have a good idea what to look for, but I don't think we've seen a peak, and I'm not going to tell you if we are or aren't near a peak. We're definitely not at a peak right now. We're still in an expanding economy, and I'll justify some of that. And so to kind of go through one component at a time, most of these I'll make very quick work of. I might not even stop on every slide, but a few of them I'll spend a pretty good amount of time kind of explaining them. Federal funds effective rate isn't necessarily that relevant right now because there haven't been any changes in a couple months. But to explain the concept, federal funds, the Fed sets policy, right? We all hear, oh, the Fed cut a quarter point today. And to give you the very quick version of what that looks like, I'll explain it in detail next time we actually see some movement in the Fed funds rate. Basically, what you need to know for today, the lower the federal funds rate is, when that goes down, it's good for stocks. When that goes up, it's bad for stocks. Why? The main reason is that it acts as bonds and CDs, things along those nature, act as competition for stocks. If the Fed hikes rates and all of a sudden CDs at the bank go from 2% to 6%, there's a lot of people that won't want to mess around with stocks anymore. The Fed, you can see on the inset there at the bottom, that big gray spike is where the Fed started hiking in 2023 to combat inflation. Or it might have been in the end of 2022. Since then, they've cut the rate by about 25%. It's still the second highest it's been since the Great Recession. It's probably at a pretty good level right now. And I'll come back and talk about that a little more when we talk about inflation. Total bank credit. This is very important. Bank credit, this is a representation of all bank lending. So add up all the loans in all the banks and how much have they grown over the last year. This is important because it's one of the earliest signs of an economic recession is usually banks stop lending. Banks are just like you and me. They're going to be more cautious if they think they're not going to get their money back on a loan, or they're going to charge a much higher interest rate if all of a sudden risk is starting to materialize. And so bank lending is one of the biggest signs of weakness in an economy. This was negative back to 2022, 2023. You can see that little blip where it's upside down, and even over to the start of 2024, or I guess just before. Since then, we've seen expansionary bank lending, which is an extremely strong thing for the economy, right? I usually tell people this usually should trend within at least 3% to 6% to see growth in the economy. And we're right. It's been getting stronger and stronger over the course of a year. We're a little bit above 6% right now. So no weakness there, nothing to be concerned about. The yield curve has been a very strange beast recently. We all learned about the yield curve back during COVID, I think, is the first time I remember it just being constant, or actually in 2022 even. It was just constantly discussed on TV. And in 2022 is because it was one of the only times in history where it dropped negative, but then we didn't end up getting a full-blown recession. I have my theories as to why that is the case, not really the topic for today. It's been used in the past to indicate a recession. If you're not familiar with it, the yield curve is when in a normal economic environment, a short-term bond might pay 1% and a long-term bond might pay 5%. Why? Because the longer you tie your money up for, the better you expect your return to be. Duration risk is the economic term. When those invert, when people are getting paid more for short-term loans, it's because there's a bigger and bigger demand, a flight to those instruments, and when those invert, it's a very negative sign for the economy. It's a very negative sign that something's wrong. That went up and down, up and down, up and down. Do I have it on the slide here? Nearly 24 times, over 24 times. In 2025, from uninverted to inverted, trading at this very narrow range. At the very end of 2025, that finally broke out into the highest level that it's been since 2022. And so does that indicate strength for the economy? As strange as the yield curve has behaved over the last year or so, I'm hesitant to take this as some kind of rubber stamp of strength. But I do find it encouraging that that we've seen so much strength. Unemployment. when I'm looking at unemployment, I like to look at the U6. And to explain that for a second, the U3 is the government report for that you always hear on the news. You know, turn on CNBC and they'll say unemployment is 4.1%, which is the headline number. I don't think it's the most useful number. What I usually look at is U6 unemployment, which includes, quote, people that are employed part-time for economic reasons and people that are marginally attached to the labor force, i.e., when people give up looking, they can still cling on and show up under this number for a while. The reason that I've been paying a lot of attention to it is because this hit an all-time high during COVID, dropped back down just as fast, hit an all-time low, I believe, or close to it, pretty soon after COVID. But since 2023 has been slowly ticking back up higher. And that is a point of concern to see that softening in the labor market and the unemployment rate. And so, again, this includes people that are unemployed part time. And so it's much more sensitive. It tends to go up before the headline employment number does, and it tends to go down slower than the headline employment number does. Um, the you can see there in gray towards the middle of the graph, the missing bar. There was one number we'll never find out because of the government shutdown. It's just not going to be published. And during that, we wake up like a bear coming out of hibernation and we go from 8.1 to 8.7 over 2 months. A very alarming economic sign. But then a strange thing happened. The next 4 months after that, we've been dropping back to where now the number at 7.9% is lower than it was a couple months ago. And you can see on the chart, it's exactly where it was 1 year ago. So for right now, we're treating this as an economic positive combined with initial job claims. Initial job claims are one of the first things to budge during an economic downturn. And so we're always keeping an eye on them before you start seeing big moves in headline unemployment. You usually see people filing for unemployment benefits. Basically, before we even get the data, which is generally monthly data for unemployment, we get weekly data on jobless claims. And so it's more sensitive, it's more reactionary. Jobless claims, if you look at the inset graph, that gray graph, it's kind of difficult to grab the scale, but it's since 2021, and this is the tail end of COVID. The graph looks insane if you look at the whole thing, but basically since that gray spike, you see it's been very steady for the course of 2 or 3 years. So there's been all these predictions that headline initial jobless claims are going to start climbing. And it even looked at some point in 2025 like it was climbing a little bit. If you go back and look at the last 15 months, you can see that basically takes us back to the beginning of 2025. There was kind of a general uptrend, but look at the last 6 months. All of a sudden, we're back to a general downtrend where employment really hasn't, jobless claims really haven't budged that much. It's a low hire, low fire economy. People are holding on to their existing jobs more than they were before. But there aren't big layoffs so far, and it's just kind of a stagnant labor market. That's not necessarily a bad thing. It's a lot better than a bad jobs market. Consumer, strength of consumer. The nature of household debt, and we use household debt. This indicator is a year over year growth. How much more debt are people taking on? And it includes everything: house, vehicles, student loans, credit cards. How much new debt is the American household accumulating? I said before, I think, that the spending is the lifeblood of a modern economy, consumption. But the problem is when that consumption is being financed through debt. And so that's what we're always looking for in terms of strength of consumer. What's interesting is that, and you can see it, I like pointing it out. It's just a fun way to look at it. You can see on the inset graph, the gray at the bottom, from 2007, You see, during the Great Recession, that was actually moving negative for one of the only times in history. I think there was a period during World War II was the only other one, if I remember right. That wasn't moving negative because people were getting more responsible, paying things down, tightening their belts. I mean, obviously they were, but the primary factor is that that's the period where loans were being forgiven and written off. So that's where we get negative household debt trending for a while. Since then, you can see it was much higher during the post COVID area, is that spike up 2022, 2023, and then down. Right now, new household debt as percent growth is the lowest it's been in like a decade. So people are spending, people aren't taking on significant amounts of debt. I don't like to belabor the point because I do believe there's something to the idea that's popular right now of a K-shaped economy, meaning people at the top are doing great, people at the bottom are struggling. There is some truth to that because inflation, which has not gone away and has been persistent, hits lower income quartiles the hardest, right? So I don't discount that idea. I do think the narrative is a little overwrought because as an aggregate, we don't see the average person taking on much household debt, even though spending hasn't really changed. And combine that with real wage growth. This would be growth above inflation. That's where we get real wage growth. So wages have been growing faster than inflation since 2023. We've had 11 straight quarters now where wages have outstripped inflation. You can see that was upside down during during the inflation of 2022, 2023. Not to repeat myself, but since then we've had 11 positive quarters. And so I'd like to combine those two charts, and I'm even going to roll back for a second. Household debt has been growing, but at a very slow rate, and a rate slower than real wage growth. And so it's normal to kind of see those two things move together. It's okay to take on a little more debt in your household if your wage is rising enough to support it. And so those moving in tandem is a pretty good indicator. And then we're starting to wrap up here. A couple more slides for today, but we're getting towards the end of it. Macroeconomic indicators, gross domestic product, real gross domestic product. So this is growth in the economy, again, above inflation. And you see that number, that thing's really kind of all over the place. Started kind of weak for 2025, a negative read, the first negative read in a couple years. And another reason that some of us were getting pretty nervous at the beginning of 2025. Then all of a sudden we had two gangbusters quarters in the quarter two and quarter three. And then quarter four was projected to be very strong, ended up being actually pretty anemic. I put it in purple there because it's not the final read. The final read on quarter four, meaning just that they update the number in stages. In April, we'll get the final read and see exactly where that landed, usually pretty close to the second read. But that shows pretty anemic growth. The fourth quarter was affected by two things, both related, tariffs and the government shutdown. And so I won't go through the whole mechanics here. I might do a helper video at some point for it, but suffice it to say, the GDP includes a subtraction of imports because it's supposed to define U.S. production. And so anything that gets subtracted from imports and reduces GDP. And obviously, if we have a big change in tariffs, then that's going to start to materialize inside of that number. The government shutdown also affected it. And so that's part of why I like to look at gross output as a value as well. It's the same conceptually as GDP, but you see it isn't all over the place because it includes some different factors. The main one is it includes government spending, basically government production, but it's a much smaller percentage of the overall economy. And so it's much less sensitive to things like I just discussed. And you can see here gross output, very stable, very steady. We don't get those early reads. And so at this point, this still goes back to the third quarter of 2025. In April, the same day we get the final GDP number, we get the final gross output number as well. And so this is a little further in terms of being outdated. One of the reasons why I look at both gross domestic product and gross output. But you can see this nice steady growth and this is also real, meaning this is net above inflation. We get this nice steady growth depiction in the economy, which I think has been fairly accurate over the last couple years. About the last thing for today, personal consumption expenditures. Usually we see CPI inflation, and that's the one that's much more common to people. I use PCE, personal consumption expenditures, in my presentations because this is the one that the Federal Reserve looks at when making decisions. They cut rates several times in 2024. They cut rates several times in 2025. In my end of year presentation for 2025, one of the things I wrote about was that I thought the stock market was getting way over its skis in terms of pricing in even more rate cuts for 2026. Doesn't mean we won't get them. I could turn out to be dead wrong. What I do know is that this sticky inflation, that unless we see a major deterioration in the labor market, this sticky inflation is what the Fed is still going to be worried about. Where it's actually 3.1% year over year produced as a monthly number, is the highest it's been since 2024. This has actually been moving the wrong way over the last several months. And so do I think that the Fed's going to cut rates in 2026? Possibly. I know that people are leaning on Kevin, or he's leaning maybe. People are expecting, I should say, Kevin Warsh, if appointed as Fed chair, to usher in a world of rate cuts, which could turn out to be the case. But you want to remember that he's only one of 13 actual votes for those rates. And so I think rates are going to be stable for a pretty good period of time. I think a lot of even market watchers and Fed watchers don't completely understand what the Federal Reserve is usually looking for. What I believe the Federal Reserve is usually looking for is as long of a runway as possible before they have to make a decision again, because they're working on historical data. And when they make changes, then they're going to wait a couple months to see if those changes fix the problem. And so I think just in general, the Fed is likely to, because the last cut was in December, my expectation, I didn't say they would go up or down in 2026, just that the market was getting ahead of itself, and that we would probably see a window of 3 to 6 months where they tried to just step back and see the effects of the recent cuts before they thought about cutting further or potentially even hiking. Both are on the table at this point. I think a cut in the long term is still more likely than a hike, but I think that neither is likely in the immediate. Last thing, I believe this is the last one that I want to talk about for today, Purchasing Managers Index Manufacturing. And the reason I want to go through this is because a survey, so this is a survey of purchase managers stating, here's what we're planning to do in our business. Purchasing, so it's published by the Institute for Supply Management, and they break it into manufacturing and services, so two different sectors. Services has been growing for the last 4 years, and so I'm not going to spend a lot of time showing you, hey, look, it's still growing. What is interesting is the sudden shift in manufacturing. And it's not necessarily unexpected. That would be a misleading term, because if you look at some of the projections that go along with these monthly surveys, you would come away with the idea this was going to grow in 2026. To see it suddenly growing starting January 1st in the data is a bit interesting. So Purchasing Managers Index, above 50 means growth, below 50 means contraction. That's all you really need to know. For the last several years, the manufacturing sector has been in a contraction. I have it on the data there. Maybe I don't have the exact number there, but only 2 of the last 48 months or something like that has shown growth up until 2026. And all of a sudden we get 2 very strong reads, the strongest reads we've had in a couple months. I left this as a negative in my January discussion. Because I wanted to get a second data point to make sure that that first one wasn't just a fluke. And apparently it wasn't. Apparently we're all of a sudden seeing growth again in the manufacturing sector, which is interesting and phenomenal and a little, not again, not unexpected, but a little surprising that we got to that. I'm going to roll back here, about 30 slides. I should have put this one at the back and just do a couple quick summary points where I try to divide things because you want to understand there's very rarely a point at which all data is positive or all data is negative. Economists are trying to figure out in what way are we leaning. Is it 70% good, 80% good, 20% good? And so I try to, at the end, parse this into a couple different positives, neutrals, or points of concern. Um, Part of the reason I pull this up is to say that one of the only concerns right now in the economy is inflation. And that has been persistent. If inflation would drop tomorrow, it would be a good thing. Everybody knows that. That's one of my only points of concern, and that's kind of the point. There's many more positives than negatives. I think we're in a very strong economy still. If we see any softening of the data, obviously I'll come back and revise that theory. But what I look at right now is a strong economy and a stock market which is sold off enough that things are starting to look pretty cheap again. A lot of it has to do with Iran. A lot of it has to do with the price of oil. And if it isn't a clear chain of events, the reason everything sold off over the last 30 days is because we look at oil and think that's going to lead to more inflation and think that that's going to lead to more difficult, a more difficult market. And so things have sold off, bonds have sold off, stocks have sold off, depending on what happens with Iran. I'm not here to predict the future. As soon as that conflict ends, obviously the sooner the better, just for stock market purposes, right? But if that ended in the near future, I could easily see a world where we start to return to pretty good asset prices. Another economic, we go into earnings season here in 2.5 weeks. And we're going to start seeing these companies report their earnings again. And if we end up in a world where the conflict in Iran is ended and all of a sudden we're getting a batch of good new data, I actually think there's at least the theoretical, logical expectation that we could move back into a pretty good stock market. Doesn't mean it'll come to pass. We've had a rocky start to the year so far, but I'm kind of optimistic for what we're looking at in the future. And so it's really, okay, 51 minutes. I didn't do that bad compared to the 45-minute expectation. For anybody that stuck around through the whole presentation, I really hope that you learned a lot. I really hope that it was informative. Feel free to reach out to us at Lifetime Retirement Partners. The website is lifetimeretirementpartners.com. I hope that you'll follow the YouTube channel, share the video if you thought it was informative. We'll be back with a lot more content in the future. Thank you and have a great day.